Welcome to Yahoo Finance Live. I'm Shauna Smith along with Jared Blickery. Let's get you up to speed on today's action. Tesla is a trending ticker here at Yahoo Finance. EV maker shares moving on another round of price cuts, in addition to an announcement here from the company that it's going to build a megapack battery factory in Shanghai. We will get an analyst take on all of that. And later, ExxonMobil has reportedly had some early takeover talks with Pioneer Natural Resources. We will tell you why the oil giant may be interested in the fracking company. That's coming up. But first, let's head over to Jared Blickery, who is keeping track of the market action. And Jared, when you take a look at it, we're not trending too far from the flat line.
Not too much. Here's the Dow. It's up a whopping 17 basis points. Nasdaq down 8. But what I want to bring to your attention, what's happened over the first first 5 trading days of this new quarter. Of course, we did have one holiday last Friday. Now, here's the Nasdaq over these 5 days. You can see it's down 1%. You compare that with the Dow, that's up about 0.8%. This is reminiscent of last year, not the first quarter, when tech was lagging and the Dow was actually outperforming. And so is that going to happen this quarter? We want to look at the bond market for some clues. Guess what? Here's the 3-month chart of the 10-year. It is surging 13 basis points. That is a huge number and coming off of 6 months lows. So I see that as a rejection of this lower area that we have right here. And if bond prices or bond yields are heading higher, that's probably going to dampen the growth trade. And what we're seeing inside the sector action today, energy is in the forefront. That's up 0.9%, followed by industrials, consumer discretionary, materials, financials. So really the value and cyclical trade outperforming here as we would expect, with tech underperforming as we would expect. Tech there down 9 basis points, utilities, healthcare, communication services rounding out the bottom. And let's take a look inside the Nasdaq, because we're going to talk about Apple and Tesla throughout the show. But the two biggest stocks here having some traditional, I would say, having some headwinds here. NVIDIA up 2%. We're seeing some strength in the semiconductors. That's another story we're going to be talking about. But for now, we want to focus what's happening in the general market and also with some of our leaders. Only Bitcoin is a true outperformer today. Go figure, up 5%, Shauna.
It's always hard to make sense of that. All right, Jared, thanks so much. Well, investors are certainly gearing up for what could be a weak or disappointing earnings season. Big banks kicking the earnings season off later this week. Now, the fallout from the collapse of Silicon Valley Bank has really spurred mixed narratives on the street as to where the economy is headed. But we've got someone here at the desk who says there's no question that we are headed into a recession. Julian Brigden, Macro Intelligence 2 Partners co-founder and president. Julian, it's great to have you here in studio today, but certainly at least from that intro, it doesn't sound like you think things are going to get better anytime soon. How much worse are they going to get?
So we wrote a 3-part series for our clients at the beginning of the year. We sort of set out how we think we're going to get an inventory cycle. So we just overstocked during COVID. We're now starting to see volume of sales start to fall, even though companies are doing well disguising it because they've been increasing prices so that the revenue's there, but the volume is dropping away, which is what really happens in the economy. The second thing, we thought we were going to already see a credit crunch even before Silicon Valley Bank. And some of our leading indicators have taken quite a material downturn since then. And then the final thing is we think the employment slowdown is coming. And that's going to kick in as we move into the second half of the year. We're losing momentum in employment. And it's all about momentum in employment. It's either rising or it's falling. It very rarely sort of sits around statically for a long time.
Julian, I got to tell you, I'm seeing all the same macro headwinds, but at the same time, you look at the technicals within the stock market, it's a different picture. In fact, here's some words from one of your recent reports. At a first glance, equities appear to be in a parallel universe because we're seeing some strength. And given all the negative headwinds we've had, you might think stocks would be down 20% in March. Definitely not what happened.
Absolutely, Jared. It's very perplexing. I think it's the most complicated market to trade. I think we are still being driven by liquidity. I mean, the Fed has had to back off from their QT with these new expansions that have driven the balance sheet to be larger. I think also we're starting, I know today's a little different, but we've seen this big roll back into the sort of FANG stocks. It reminds me a little bit of the height of COVID. We had these stocks that we bought because they could kind of grow when there was no growth, right? They essentially became replacements to the bond market. And if you look at that relative price action, that's what's been driving us, outside, the last couple of days, the market in general. And there's such a big weighting in the index that they support the index. So yes, I'm sitting here going, this really shouldn't be happening. But the reality is, unfortunately, the equity market, since the Fed pumped in trillions and trillions of dollars, has become a liquidity play, not necessarily truly a macro play. We'll just expand PEs again if we have to.
So let's just talk about this potential liquidity play right now, because we are seeing ongoing QT, that's quantitative tightening. The Fed was in the middle of lowering its balance sheet or shrinking its balance sheet, had to expand that briefly. It looks like it's heading back down. But then you take the latest bank readings, bank statistics we got from the Fed last Friday. They're saying that lending is contracting by the fastest pace since the global financial crisis. So liquidity is not right there, at least in certain metrics. Wondering how you incorporate this into your general theories here.
So I think when you look at the overall economy, it's very important because that helps you select the sectors that you want to be in. When you look at the broad market, I tend to look at the liquidity metrics. So I'll weight my views in the equity market based upon those two metrics. And I would agree. I mean, the data that actually came out last week is actually lagging to a lot of our models. So our model showed big deterioration. I think the one that you've got to focus on coming up is going to be the senior bank loan index, which comes out, I think, in first week of May. The Fed actually will be very interesting because the Fed will have that going into their meeting. So it could be a tell if they don't raise rates, because the base case is that
Nick
they do.
Timmerhouse will tell us all a week beforehand,
Right.
or a day beforehand.
Absolutely. You're spot on. So I do think, we've got to watch this broad liquidity provision. I think they've probably done what they need to do for now. We're not seeing a domino sort of run on these regional banks. I do think it's going to be more of a slow bleed out and tightening of credit. And I think that will just affect broad economic activity. The overall level of the market, I think, gets set, though, by that combination of the Fed's balance sheet, the repo market, and what the Treasury does with their Treasury General Account. That's where the broad market gets set.
Well, Julian, given all that, clearly investors, you think, should take a defensive position, I would guess, right now. I guess how defensive should that positioning be at this point?
So personally, I'm sitting on a decent amount of cash. I've been investing it in the sort of front to middle part of the Treasury curve. I don't want to go too far out because I have some concerns further down the line as to rates. I've been playing international. We've been looking at precious metals. They're coming up to some quite big points. If we can break above those, I think we can have a decent run. I generally think, though, as we look out 6 months, that investors have to watch the dollar very carefully, because I do feel we're at one of these inflection points where we could start to move, where this dominance of the US, where the US has been the only place to put any money for the last decade, is starting to change. And I think if you get in at ground level, there's an awful lot of money to be made in these markets.
Quick follow-up, because we got time for one more. Where would we put that money in effects? Yen, because we do see a strengthening of the yen at this term in the business cycle, but maybe you're talking about something different.
So we've been long yen. Today was a bit of a painful day after Ueda came out and said he's not doing anything and shot dollar yen. But we've actually been long yen and short the dollar against that. The one I'm watching very, very closely is the euro, and if only because it's a dominant part of all the big indexes like the DXY and the dollar index, but also because it's coming up to some very, very important levels. Sort of 109.30 level is a big level that I'm watching. I think if we can break that, we would likely, 80% of the time, you set the highs and lows of the year in the first 3 months of the year. So if we start to break above 109.30 and then above 110.30, the odds are this is a dollar down year, a euro up year. And that, I think, will set the tone for a lot of, certainly our investment thesis, if you get dollar weakness.
Julian, let's talk a little bit more just specifically about inflation, the cost pressures that we certainly have seen there. The inflation obviously remaining much higher than where the Fed would like to see it. We're getting that data point later this week. When do you expect to see substantial improvement? By that, I mean a pretty big drop with inflation. Is that something that you think we could see by year end, or are we looking out into 2024?
So I think headline is coming down now. I think we're in the process of seeing that happen. And the market is looking for a pretty abrupt drop in headline inflation. Most of our work is suggesting we start to peak out in the fourth quarter and only start to aggressively drop in 2024. But once again, we're coming down. but we're coming down really for the wrong reasons.
Yeah, certainly. And something. Julian, I love having you on set. I'm a little worried, though, about the predictions, I gotta say.
I think there are plenty of opportunities. They may not be where people have made money in the last decade.
Yeah, very important to point out. Julian Brigden, always great to speak with you. Thanks so much.
Thank you very much.
All right, let's do a quick check of the market, sponsored by Tasty Trade. Again, you're still looking at a mixed picture. The Dow just holding on to gains, up just about 54 points. S&P and Nasdaq trading in the red. You're looking at the Nasdaq off about 0.1%. Well, we are just getting started here on Yahoo Finance Live. Coming up, the road ahead for Tesla, the EV maker cutting prices on its electric vehicle lineup in the U.S. for a third time this year. We will talk to one analyst who's bullish, who says that Tesla is capable of this, more so than some of its competitors. He'll tell us why on that. And it is a bumpy ride for the airline industry. The FAA saying the air traffic controller shortages may result in fewer flights this summer. We're going to speak with the CEO and chairman of Mesa Air Group. He'll dive into all of those headlines for us, tell us what that could mean for the price of air tickets this summer. Don't go anywhere.
Big bank earnings, key inflation data, and fresh news from the Federal Reserve. We've got a huge week ahead for the markets. Here's what you need to know.
The country's largest banks will report earnings next week. JP Morgan, Wells Fargo, and Citigroup all set to post their first quarter results, set against the backdrop of a possible banking crisis. Wall Street will be watching closely for performance on deposits and bank liquidity, while top executives give insight into the health of the U.S. banking system. Plus, we'll receive new inflation data and retail sales figures for the month of March. Will we see inflation continue to trend downward? All of this, of course, is being carefully considered by the Federal Reserve. Americans will pick the brains of Fed policymakers throughout the next week as we hear comments from several central bank officials and get a readout of the minutes from the March policy meeting. What does all this mean for interest rates and the stock market? We've got you covered right here at Yahoo Finance.
Welcome back. The Fed has a big decision to make at its next meeting on May 2nd to 3rd. The probability of another 0.25% hike is now at 72%, and that's according to the CME FedWatch tool. The Fed's decisions are always backward-looking in terms of data, but this time around, that problem will be worse. Since its meeting is at the very beginning of May, the Fed actually won't have much data, specifically from April, to look at. So the board is going to instead to be basing its decisions off of economic data from March. And Shauna, would you please break this down for us?
Oh, I will, Jared. Let's get to it. A couple of data points that the Fed is going to be looking at. One of the biggest data points actually came out this past Friday, April 7th. That was a jobs report. Now, we did see the labor market cooling slightly in March, but remember, unemployment actually ticked down 0.1%. So some indications there, obviously, that the labor market is still tight. Next up on Wednesday, we will be getting the latest reading on inflation with the March CPI report. Consumer prices are expected to stay strong. According to Bloomberg estimates, CPI is expected to rise about 0.2% month over month basis, down from that 0.4% in February. And our final indicator, also the Fed's favorite measure of inflation, PCE, that, Jared, is going to be released on the 28th.
And will the lack of recent data make the Fed's decision any harder? For more on this, we're going to turn to Tiffany Wilding, PIMCO Managing Director and Economist. Tiffany, thank you for joining us here. So you were just listening to Shauna point out some of the dearth of economic reports for the month of May or even April that we're probably going to be looking at. Explain the Fed's conundrum here, and particularly in light of the fact that we're just coming off a bank crisis.
Yeah. So I think overall, just taking a step back, the Federal Reserve obviously takes in data as it comes, but it's not exactly the data. It's how the data impacts their forward-looking forecasts that really drive monetary policy decisions. And I think the issue here is there's still a lot of uncertainty around how the banking sector stress that we saw in mid-March will impact the outlook. And we haven't, unfortunately, got a lot of, data and reports to kind of understand the possible magnitude of that. So I think that's really what the Federal Reserve is going to have to deal with. I think they know the direction, that the effect will have. In other words, this should cool loan growth. It should be a drag on GDP growth. Ultimately, that will flow into labor markets and inflation. But again, really, it's the magnitude here that matters. So in the interim, the Fed is still in this period of trying to decide, whether the focus should be on risk management to elevated inflation or, some of the banking sector stress. And I think given that we've seen this banking sector stress kind of die down, their focus is probably going to be on inflation. It's probably going to lead them to another rate hike, absent, again, anything sort of popping up in the interim.
So, Tiffany, then if we do get another rate hike, and talking about some of the data points that we will get here over the next couple of weeks ahead of that next decision in May, what do you think is necessary for the Fed to eventually either hold steady or pivot if we do see that before the end of the year?
Yeah, well, whether they hike again in May or not, we think they're effectively pretty close to being done here. And the data that we look at more recently, high frequency data that looks at credit card spending, or even some leading indicators for the labor market, really suggest to us that we are seeing a pretty meaningful deceleration in activity and in spending, and ultimately in hiring. We obviously heard from a lot of large companies around the turn of the year that they were laying off significant amounts of people. We think that the effective dates for when those people actually get laid off are actually around the turn of the month here, so around at the end of March. So that might not get picked up in the government data, the payroll reports, until the April report. But we do think it's happening. So I think there is a deceleration in activity that's happening that will continue as small businesses aren't, it's going to be more difficult for them to get loans. Obviously, rates are higher, financial conditions just generally tighter. So we do think you are going to see a modest recession probably start later this year. But in terms of what it takes for the Fed to, not only to stop but actually ease policy, I think unfortunately here it's still going to take inflation coming down. Inflation lags broader growth, fundamentals. And so there's going to be a bit of a lag time when growth decelerates before inflation, really starts to, more convincingly come down towards target. So, that's kind of the dynamic that we're going to have to deal with. The Fed's probably not going to be as quick or as aggressive to ease as what we've seen in the recent past, to the pandemic or even to the 2008 financial crisis.
Nevertheless, when the Fed cuts, it usually cuts pretty quickly, and the market has a difficult time predicting exactly when that inflection point is going to be. Just wondering, because we've seen since the Fed started getting hawkish about a year ago, I would say market participants have been very quick to price in these cuts. Do you think the market is finally starting to get it right now, where we have potentially cuts coming in towards the end of the year? Just wondering, in terms of timing, do you think finally it's time to start thinking about that Fed pivot when it really hasn't been in months and quarters past?
Yeah. Well, just to, I guess, like some historical context, which I think is helpful, but if you do look over the hiking cycles historically, what you find is that when the central bank in the United States, at least, gets to the top of the hiking cycle, on average, it's been around 6 to 7 months that they spend up there, and then they start cutting, and then kind of on average in the year when the cuts, in the year after the cuts start, they have cut by about 300 basis points, and obviously many hiking cycles, it's more like 500 basis points are full cuts. So yeah, I mean, I do think that the fact the market is pricing in cuts, and it has, I think, is completely consistent with that historical, just analog and precedence. And it's reflective of the fact that financial conditions are tight. And, it's very difficult for the Fed. They're trying to slow down activity. They're trying to engineer demand lower. And with the blunt tools that they have, it's very difficult to do that in the kind of maybe fine-tooth way that, they might hope that they would be able to. Now they've argued over the last year that they are targeting a, quote, soft landing. Our own forecast suggests going to be soft-ish. We do think you see a modest recession. The unemployment rate, is going to rise. But nevertheless, I guess we would also argue that we don't think we're on the precipice of a 2008 style event here. Even in the context of some of the banking sector stress, there are, some positives about the economy that probably provide some supports, and that is excess savings on consumer balance sheets. And on average, the large banks are very well capitalized, and actually state and local government spending, we think is actually probably going to be very resilient as a result of federal government outlays towards infrastructure spending, as well as some other things. So, there's some good and bad things here. I think overall it kind of suggests to us that, modest recession, still likely inflation coming lower. And in that kind of environment, the Fed can ease and start to ease potentially by the end of this year.
Tiffany, what's your reading just on business sentiment? Because when you take a look at the most recent ISM surveys, it seems to be possibly declining just a bit. If that is also true, then how do you then see that affecting the jobs market down the line? Is it going to lead to maybe more cautious hiring pattern here over the next couple of months?
So you're right. The purchasing manager surveys, did fall. The latest ones did suggest that things were, slowing and even contracting in the manufacturing sector. And ultimately, I do think these banking sector issues will spill over effectively into the job market, because small banks tend to be the biggest lenders to small businesses. And small businesses are very important to the broader economy and very important to hiring. In the post-COVID, recovery that we've had, it was really the recovery for small businesses, that generated a lot of the hiring that we saw. So I do think as you have these smaller businesses that, maybe it's more difficult for them to get loans, they just aren't going to be able to hire the people or open, that new, branch or shop or what have you. And again, that's going to slow hiring. And we could potentially see contraction in hiring as a result of that as well.
All right, we got to leave it there, but really interesting insights. PIMCO's Tiffany Wilding, thank you. And a quick programming note, be sure to check out our own Jennifer Schonberger's exclusive interview with New York Fed President John Williams. That is tomorrow at 9 a.m. Eastern. You don't want to miss it. And Tesla shares are down a little bit after the company, there you can see, down about 0.25% after the company slashed prices on its EV lineup for the third time in the U.S. this year. We're going to tell you what this means for Tesla's stock, all when we return.
Let's do a quick check of the market sponsored by Tasty Trade. You're looking at the Dow barely holding on to gains, up just about 29 points. S&P and Nasdaq trading to the downside. You're looking at the Nasdaq off about 0.2%. Communication services technology among the underperformers in today's market. But it really looks like we're almost in a holding pattern here ahead of the busy week that is ahead with the econ data on tap there, Joe.
Yes, that CPI investors expecting. But we got to talk of Tesla here. The shares down just fractionally, about 0.5%, as investors digest more price cuts and a new factory in Shanghai, China. Joining us now with more on this is Tom Narayan, RBC Capital Markets lead equity analyst of Global Autos. Thank you for joining us here today. Let's just talk about the price cuts in Tesla, down another 4%, as you're noting in your notes to us, down about 19-20% year to date. They're leading the pack here, and they got a little bit of room to run. Just wondering how long they can keep this up.
Yeah, I mean, they're in a unique position, right? Because they have kind of the best cost structure, right? They don't advertise, they don't have dealerships. So I think they have the ability to cut prices more than a lot of their competitors. They're also obviously earlier to EVs than others. So it's a great way to really steal market share, I think. And ultimately, they also have a lot of things that kind of go in their favor. They're the biggest beneficiaries of the IRA tax credits this year. And also two of their plants, Berlin and Austin, are really ramping up, and those are going to reduce costs over time. So, yeah, I mean, it looks like a big headline, right? Cutting pricing by like 20% for some of the models. It sounds pretty dramatic, but when you really look at how they can lower costs, it's really a great way for them to gain market share. There will be some near-term pressure on profitability, no doubt. But I think the market really understands this. And you're seeing the stock reaction. It was down more this morning digesting this news. And now it's really come back in. So I think the market is really digested a lot of these price cuts.
So that's interesting then, there, Tom. I guess because really the trend has been that Tesla has been losing its market share. But you think that these price cuts are actually going to reverse that? Am I understanding that?
Yeah, I mean, losing market share is kind of an unfair thing, just because there's new entrants coming in that didn't exist before, right? So obviously they're going to lose market share, but that's coming off of such a high number where they were the only game in town. But really, it is a rising tide lifts all boats. Tesla wants other EV makers because the biggest competitor to Tesla is actually non-EVs. Right? It's people who are holding back on buying an EV. If there's a ton of EVs out there, there's more of a reason for you to buy a Tesla. So losing market share in a weird way is a good thing, because it means that more people are buying EVs, even though it's competitors. And it means that more people are buying EVs as opposed to ICEs. And certainly by them cutting pricing, there's no doubt that they've been gaining market share now. Certainly over those who haven't cut pricing. Just look at the delivery number they posted last week. It beat expectations around 420,000 for the first quarter. So I do think that this strategy of cutting prices is going to lead to higher sales. And fortunately for them, they do have some unique characteristics that make it so they don't have to sacrifice too much on profitability.
Yeah, and Tom, that makes sense when you put it that way, certainly. We had you on just about a week and a half ago, and you were expecting Tesla to deliver 445,000 vehicles. It fell a bit short of your expectation there. What's your overall takeaway just from the demand picture right now for Tesla and how it is as we enter the second quarter?
Yeah, I mean, we probably overshot a little. We were looking at app download data and trying to extrapolate. You can never be too sure about using these types of methods. But at the end of the day, it did come in above expectations that were there just a week or two earlier. So, yeah, we may have been a little too high, but for the most part, that's a strong number. And now further price cuts, it's only going to help them gain volumes even more. Especially in China, where a lot of the competition is. That's where we're really seeing a pain point for some of their competitors, notably people like Volkswagen. And so it's a great way for them to at least maintain their position to the domestics like BYD, et cetera. So I think price cutting is just a natural thing that they have to do to keep growing. That Q1 number is really strong, and they're just doing it to kind of keep the momentum going. I also think they have their own view of the economy Elon has talked about this in the press. So maybe he's a little bit more bearish on the consumer, especially in the US. And so it could also just be some caution into a macroeconomic uncertainty in the back half of the year. And you know what? If it doesn't happen, if we don't have a severe recession, like your previous speaker was saying, then it's just a great way to gain market share.
I want to spend a minute also talking about Tesla in China, but moving on to batteries. And this has to do with the mega pack. Within the last 24 hours, Tesla announcing that they're going to build a factory in Shanghai for mega pack batteries with 10,000, targeting 10,000 per year. Each of these mega packs could theoretically power 3,600, so 3,600 homes for 1 hour. And could you just give us maybe back up, give us a big picture on this and why this is important toward the electrical grid and what this means for the future? Because people think Tesla cars, but it's also power and these mega packs.
Yeah, it's a great question. It's really great that this is happening now, so people get kind of educated. The fact that this is a completely new business opportunity for Tesla, and then a very, very important topic for the energy transition, and that is how utilities can use renewables more efficiently. Right now, solar and wind, you only get them when it's being produced, right? When it's sunny outside or there's wind. Now with battery storage, you can actually time shift when you use these feedstocks basically for utilities. For China, it's a very big deal. For Europe as well. They're net importers of fossil fuels. And now they can use renewables, which is just there, right? Solar and wind. So battery storage allows them to time shift when they use it more efficiently. And what Tesla is doing is it's another big piece of their business, or will be potentially in the future. Right now, it's fairly small, but total addressable market for energy storage could be in like half a $1 trillion market by 2030, in huge business opportunity. And Tesla is really one of the leaders in this space. So, you know, what they're doing here also, and it has great impacts. You could, avoid blackouts in the US that was used in California. Right. There's a lot of uses for energy storage. And now by them investing more, this is their second facility now, they can export some of that. They can utilize that in China as well. It's a great way for them to remind folks that they're in this business as well. Yeah,
being able to store sunlight during the day and actually use it at night, as simple as it sounds, it's been elusive at scale for a number of decades here, finally here. Really appreciate your insights, Tom Narayan. Well, coming up, shares of AMC, they're trading higher after a blockbuster weekend, no pun intended. We're going to tell you which films moviegoers they watch the most on the other side of this break.
The New York Auto Show is here, and as attendees rush through the gates of the Javits Center to see what's latest and greatest and what's next in the world of EVs, what they won't be seeing is this brand, Tesla. That's right, Tesla. Tesla doesn't really go to auto shows in general or even industry events. They usually do their own thing. And what they've been doing lately is dominating the field of EVs from both a production but also a scale point of view. But now Tesla is leading in a new area, pricing. Only weeks ago, they threw down the gauntlet, cutting prices of the Model 3 and Model Y cars by thousands of dollars. Rivals like Ford and even Chinese rivals had to cut prices in order to compete against Tesla's latest move. And right on cue, Tesla reported Q1 delivery numbers that were record highs for the company, as they showed that cutting prices boosted demand considerably. And 2023 is not only a big year for EVs and EV SUVs in general, but also pickups. This year at the show, the Ram Revolution EV pickup will be there, as well as the Chevy Silverado EV, in addition to the Ford F-150 Lightning EV pickup. Now, what's not going to be there again is Tesla and their Cybertruck. Cybertruck, Tesla says, has over 100,000 pre-orders, and it will go into production later this year.
It's time for Triple Play. 3 stocks that we're watching the final 20 minutes of trading. We've got Topgolf, Callaway Brands, Bed Bath & Beyond, and AMC. Kicking off my play today, that's Topgolf Callaway Brands. Shares are moving to the upside now. Masters winner Jon Rahm put the brand on display all weekend while playing at Augusta National and then winning. Jefferies analyst Randy Connick thinks that the stock still has room to run. We're talking more than about 170% upside in a note. Connick wrote that the market has yet to, quote, fully appreciate Topgolf Callaway Brands' transformation into a golf entertainment platform, and that is going to widen the company's total addressable market. Connick also thinks that the tailwinds here for golf remain favorable, and also that Topgolf Callaway will capitalize on that growing interest that we have seen in golf. Josh, I got to tell you, there's lots and lots to talk, obviously, about golf today, the Monday after the Masters. That makes a lot of sense. But people love going to Topgolf, and I think that's really helping get more people interested in the sport, and then maybe eventually go out and play 9 or 18 holes.
Yeah, there was a chart in there about off-course only golf participants, so people that only play off the course and don't actually go and play 18. That number's tripled in the last 7 years, and that's sort of where Topgolf falls into. So that was interesting to see. And Shauna, they talked also about the larger ecosystem there, and when you look at TravisMathew, I thought it was interesting to look at how that apparel brand has grown. That's grown from net sales of $61 million in 2017 to over $300 million in 2022. So you see that TravisMathew brand really growing. And then, Jared, I did bring a chart with me today because I know you're our chart master. They have one other fun chart in there. This is the average age of golf participants, the average round that they play per year. And it's hard to maybe see any support levels, as I know you like, but I thought it was funny. You can see from 30 to 39, it actually ticks down a little bit, maybe as
kids.
Some of our, I was going to say, some golfers start
now,
to get kids. And then you see it really rise. So you see that demographic still very popular. The sport, obviously, in the elder generation there, where it looks like people are probably retiring.
Love it, Josh. I got another chart for you. It's on the Wi-Fi Interactive, by the way, and it's Topgolf over the last 5 years. Let's chart this real quickly, then we'll get into my top take. Here we go. This is over the last 5 years. Interesting that we have this breakout from this multi-year trend line. We've had that big decline over the last year and a half as a lot of stocks falter there. But here's the max chart on this, and it goes back basically 40 years. Looks like they IPO'd in the early 90s, and over the pandemic managed to double top there. Huge double top spanning about 25 years. You don't see those often. I don't know what it means in particular, but there you go. All right, my triple play is Bed Bath & Beyond. The stock dropping to a record low of 28 cents as the beleaguered company pushes for a reverse stock split at its upcoming May 9th shareholder meeting. The home goods retailer says it has just over 428 million shares outstanding as of March 27th. That's an important date because only shareholders of record on that date will be able to vote. Company also saying, quote, the company has received several inquiries from shareholders regarding naked short selling, going on to say they don't have specific knowledge of this and is unable to confirm the activity, and that nevertheless they denounce any market manipulation of its stock. I would venture that it's really not that important at this late stage in time. I think they're going to need to figure out their financing. I had a nifty chart on our meme stock heat map here. Here we go. Just wanted to show you that the sea of green that we're seeing here today, Bed Bath & Beyond, well, that's going to be right near the bottom. That's a year-to-date look, by the way, down 88%.
Yeah, Jared, it really seems like that May 9th date is going to be the one to watch, right? Because we know Bed Bath came out and said last week that if they are not able to obtain shareholder approval for that reverse stock split, bankruptcy is definitely on the table. And then, of course, the first 10 days of a month is a common time for retail companies to file. Circuit City filed back within that first 10-day mark. So did Sports Authority. That has to do with how these companies pay rent. So it seems like that early first 2 weeks of May is going to be what's to watch here, Shanna.
That's a really interesting point. I didn't realize that. We also talked to Goldman's Kate McShane about this last week, and I asked her, is there any scenario where Bed Bath & Beyond does not file for bankruptcy? And she didn't necessarily say that bankruptcy was inevitable. She talked a lot about inventory levels, why that is so critical. They obviously need some inventory in terms of what people are going to want to buy to stay afloat for this time. So I don't know, maybe they are somehow able to get out of this mess.
It's a meme stock triple play, but we're talking about fundamental news. How about that? Yeah. I've got another one for us, guys. AMC shares rising today after the movie theater chain's best weekend of 2023. AMC says it welcomed more than 3.6 million moviegoers from Saturday to Sunday this past weekend. Revenues on Saturday reaching their highest single-day mark since theaters reopened after the COVID-19 pandemic. Now, two big names led those sales: Super Mario Bros. The movie and Air, the story of Nike signing Michael Jordan. Super Mario Bros. Totaling $146 million in domestic box office for its opening weekend. That's the highest amount yet this year. Shauna, the biggest takeaway for me is, one, I didn't realize how excited people were for Super Mario.
Me neither.
I thought the movie would be a hit to some extent. I didn't think it would be this big of a hit. And number two, people are going back to the movies for something to do on a holiday weekend, right? Mm-hmm. People went to just go to the movies because that's what families do. I did. I went to go see Air. I would have gone if it was on any weekend. I was very interested in the movie.
Yeah, it is interesting. I mean, obviously this is a massive weekend here for the box office, but if you take a look at the year-to-date levels, we're still about 20% below where we were in 2019. Mm-hmm. So I think the overall takeaway, at least just from this weekend, is yes, this is huge. Yes, this is a step in the right direction in order to really get the movie business possibly back to where it was pre-pandemic, although we still have got quite a ways to go. I don't know. I'm not going to be seeing Mario Brothers anymore.
I'd see Mario at home.
I'd see Air first.
Air first, definitely. Yep. I would love to see that in theaters. All right. Well, coming up next, Mesa Air Group Chairman and CEO Jonathan Ornstein on what a shortage of air traffic controllers could mean for the airline industry next.
The surprise production cut from OPEC Plus sent oil prices spiking, with research from Jefferies projecting a similar price shock to jet fuel over the next month. Here to discuss the outlook for airlines this quarter with what those production cuts could mean for the industry is Jonathan Ornstein, Mesa Air Group Chairman and CEO. So thank you for joining us here today. Might not be the first thing we think about, but rising fuel prices got to factor into the airlines. How deep could this resonate?
Well, prices are still at levels that allow the airlines to operate within the, sort of the range of what they would consider normalized pricing. I mean, if we got up over $100, I think that starts to have an impact. But I think, between, 60 and 80, 90, I think those are kind of shocks that would not have the impact that it might have if you started to see fuel prices, really accelerate above 100.
So, Jonathan, you have the risk here of rising fuel prices. Also, the fact that we just heard from the FAA last week warning about air traffic control shortages. Some airlines might be pulling back here on some of their flights this summer. Is it affecting Mesa at all? And I guess, how do you see that maybe affecting your planning down the road?
Yeah, I think, there's just been a shortage throughout the industry in skilled positions that has really been, at least in the regional business, crippling. The air traffic control is specifically, probably centered more around peak periods, peak holidays, and also in certain areas. For example, there was a big problem over this past year with so much traffic going to Florida, and the inability for ATC to manage that traffic efficiently. I think the bigger issue, at least particularly for the regional airlines, has been the shortage in pilots that has just had a significant impact with, capacity reductions, oftentimes, in the 40% range over what could be flown under normal circumstances. And, this all goes back to changes in regulation that have required pilots to have more hours. And that has just really put a real kink in the pipeline. And it's made it really difficult to keep up, particularly when the majors coming out of COVID began to hire, many of our pilots to fill the requirements that they had that came about due to early retirements and, just the basic demographics at the main line. So we currently have a not insignificant portion of our fleet parked. I think other regional carriers are having the same issue. And, it just takes a long time to get people trained, and it takes an even longer time to get those people to the position where we can hire them. So that's probably had a bigger impact on us. That's just been, really, frankly, somewhat overwhelming.
Yeah, and Jonathan, you guys talked about that in your last earnings call as well. How long until you think some of these issues then are resolved? Are we talking 6 to 9 months, or is this an issue that you could see lasting for years to come?
I think that without appropriate action at the federal level in terms of Congress, and then the FAA sort of following through on some of the initiatives that have been discussed, I think this could easily last 5 years and maybe longer. There is some discussion now about raising the retirement age, which I think is entirely appropriate. Pilots have to get medicals every year. Obviously, they would keep a close eye on people as they approach retirement age. I think that's one of the things that really needs to be done. I think there are other training avenues that could be explored. But right now, where we have a requirement in the United States that's 5-6 times higher than the rest of the world, and at the same time, pilots flying for KLM and Lufthansa and JAL are all flying into U.S. airports with 1/5 the time as a pilot. I think it's pretty outrageous to discriminate against U.S. pilots like that, and we're doing it right here within our own country. So hopefully we can see some action. I think it's really important, or this is a problem that will not be solved anytime soon. That I can assure you, it's going to take a long time, multiple years.
And your company is taking some steps to alleviate the dearth of pilots. Can you just briefly go over some of the initiatives and some of the incentives you're rolling out?
Yeah, I mean, one of the big initiatives that we started, obviously wages had to increase because we had to sort of stop the flow of pilots going to the low-cost carriers who were, effectively taking our pilots at will. Now, we've been able to stem some of that attrition, but the bottom line is the problem is not so much attrition, it's just people coming up through the pipeline. And one of the areas that we've done has been to begin basically allowing pilots the opportunity to build those extra, over 1,000 hours that they need after getting a commercial license to then actually use that commercial license and fly commercially. So we've begun a program using light sport aircraft where we're effectively loaning the pilots the money to build the time at a very, very low rate. I mean, 1/4 what the commercial cost would be to them, and then building that time and then coming to Mesa once they have the time to do that. Another problem that we have along that is even once they get to Mesa or another regional airline, they need a certain number of hours to then be able to upgrade to captain. Well, now pretty much every regional airline in the country has been stymied in their ability to add capacity because they don't have people who have the required hours to upgrade to captain. So this problem just is compounding as a result of this legislation, where now even if you have the flow up, you don't have people qualified then to become captains, and that's all due to the high level of attrition that the industry had been facing as a result of the majors now adding people and the pipeline having been basically closed for so long. So it's a multifaceted problem that's going to take a lot of work, both within the industry, within Congress, with the work groups, the pilots themselves, It's just something that needs to have a cooperative approach. Or the people who will pay will ultimately be the consumer, because they'll be paying in fewer flights, fewer cities served, and higher prices. And that's all just part of what a shortage is about.
Jonathan, great stuff there. I wish we had more time with you. We'd love to have you back on Yahoo Finance soon. Chairman and CEO of Mesa Air Group. All right, well, after fast-tracking Eisai and Biogen's Alzheimer's drug Leqembi in January, the FDA will be convening a panel of outside experts in June to discuss full approval. Yahoo Finance's Anjali Kamlani joins us now with more. And Anj, what does the timeline look like for this, and how significant could this be?
Well, this is significant for the company because it broadens the potential customer base that the company has. Right now, they have that fast track approval, which gives them the ability to market the drug and whoever is willing to pay cash. And so what we're looking at now is the June meeting of the outside panel of experts, and then the FDA's final decision. Looks pretty promising based on the company's expectations. We had spoken to Eisai US Chairman and CEO earlier, Ivan Chung, and here's what he had to say about that.
Saying that on the same day of Leqembi receiving a full traditional approval, a broader access will be provided. We find that very encouraging, and we have been working very closely with the CMS, including a recent meeting after the Leqembi accelerated approval to chart the path forward.
So as you can hear, they already were working on this, charting the path forward. They're expecting the approval this summer, so looks like things are already on their way.
All right, we got to talk Texas here for a second. The pharma industry responding to this Texas ruling on the abortion pill, stirring up some controversy here. What's the latest?
That's right. So the drug companies are worried about the impact that this has. There are multiple reasons why the FDA could, see its authority really interfered with, but the drug companies themselves are worried about the impact long term for the industry. What if any drug, just like, we were just talking about Eisai, their partner Biogen with those Alzheimer's drugs, do you remember the drama over Aduhelm? So they're worrying about stuff like that could come down the pike. They said in this letter, quote, if courts can overturn drug approvals or evidence, or for the complexity required to fully vet the safety and efficacy of new drugs, any medicine is at risk. So it opens up the floodgates for, already a very litigious situation in industry. People already sue the companies a lot. So this would just make it one step worse. And we've seen some really big wigs sign on just today. Pfizer among them, Biogen among them, as well as CRISPR and Merck. So really interesting lineup right there.
It's certainly a story I'm sure that we are going to continue tracking. Anj, thanks so much. Let's get a quick check of the markets here. The final minutes of the trading day. You're looking at the Dow up 61 points, Nasdaq off about 0.1%. We'll be right back with the countdown to the closing bell.
We are minutes away from the closing bell, and we got a mixed market right now, but nothing's doing too much. The Dow slightly up, the Nasdaq slightly down, the S&P 500 just treading water there. By the way, bond yields shooting up today, having an impact really weighing on growth stocks, but the value and cyclical trade has been humming. Industrials up 0.8%, followed by energy, materials, real estate, consumer discretionary, and financials. It's communication services and utilities, each down about 0.25%, that are really weighing on things now. Here's the Nasdaq 100. We're going to talk about Apple in a second, but that stock is down 1.7%. Meanwhile, chip stocks doing well today. We're going to talk about them. NVIDIA, you can see, up 1.85%. And just looking into some of our leaders and sentiment indicators, I talked about Bitcoin leading the day. Well, Baito is up almost 5%. Second to that is EWY, that is a South Korean ETF, and then you have solar energy. So kind of random what we're seeing at the top. To the downside, KWEB, that red square you're seeing at the bottom, that is Chinese stocks. Those are faltering today. And with about 30 seconds to go, let's take a look inside there. Baidu down 4%, EDU also down 4%. Looks like a number of these are in the green, but not so meaningfully. Also going to take a look at the disruption trade, faltering today, except for Coinbase. Did mention Bitcoin strength. Coinbase up about 7%. And here's your closing bell.
Well, that does it for today's trading day. Again, the Dow and S&P looks like they're going to eke out gains. This market check sponsored by Tasty Trade. The Nasdaq closing just below the flat line, barely though, as we shake out the final trades. Technology, communication services among the underperformers in today's action, along with utilities and healthcare. All right, let's dig into some of the big movers of the day. And first, we got to start with Tupperware. Shares of the container maker hitting their lowest close on record after the company wrote in a regulatory filing that it had, quote, substantial doubt about the company's ability to continue as a going concern. You're looking at shares off about 50%. No surprise there that language like that is going to trigger that type of sell-off. And Jared, it's really hard to figure out the future here for Tupperware and how it ends in anything other than what they just warned about today.
Yeah, I am old enough to remember being dragged to some Tupperware parties when I was a kid. My mother, fortunately, she did not get on that multi-level action herself. But yeah, I mean, this is a penny stock. We're seeing a bunch of friendly consumer names that people have known for decades that got blasted higher during the pandemic, only to see their fortunes fall when we had a huge regime change in interest rates with the Fed hiking massively. So there are a number of companies that have just been basically zombies for years, barely covering their debt, barely covering their interest payments, and having to go into debt further. Well, that game is over. That shell game is over. And I think this is emblematic of it. So let's take a look at Micron. Those shares popping today as Samsung plans to cut part of its memory chip production. It looks like Goldman Sachs writing in a note to clients that Micron, which already owns 22% of the DRAM market, should benefit from Samsung's cutback. And I would say that memory is probably one of the most cyclical parts of the economy, and that's why it's always a leading indicator, a bellwether, if you will, of what's going to happen with the general PC market and tech sales. So this is very important here, and it's usually very forward-looking. So we're talking about the market recovering in a couple quarters here. In terms of the inflection point, that's usually when we see the stock turn up in anticipation of that. But hard landing, recession, maybe that's a monkey in the wrench.
Yeah, certainly, Jerry. When you take a look at the analyst commentary on that, they were pretty encouraged by this Citi Out, which has a buy rating on Micron right now, saying that they actually now see a recovery in those chips the beginning of the second half of the year when it comes to what we could see in terms of financial performance here from Micron. KeyBank, also similar, just in terms of the fact that this is really bolstering their confidence regarding some of the disciplined CapEx investments in memory that Micron has made. So Micron among the movers in today's action and certainly trending to the upside. We'll see whether or not that holds going forward.
You bet. And we want to stick with tech now and take a look at Apple. Look at Apple stock. This is one of the biggest losers in the S&P 500 today. New data is showing that Apple's computer shipments, they declined by 40.5% in the first quarter. This is a jaw-dropping statistic, but we're not seeing the market react that strongly to the downside. And here I have a 2-year chart of Apple. The reason I think this is very important is because we came out precisely just a few days ago to this negative trend line here on an overbought basis. And whenever that happens, usually you get a pause there and you just wait for a new catalyst. So until we get that new catalyst, Apple probably in a holding pattern. What is that catalyst? Could it be CPI? Maybe it's just its earnings in another month. Who knows?
It might be. And Jared, when you dig into these numbers, so yes, those were Apple's numbers specifically when it comes to PC makers, when it comes to shipments there for their Macs. But for all of PC makers, this report saw that it slumped about 29% to 56.9 million. I bring that up because this is the lowest level, falling below the levels that we saw in early 2019. So yes, Apple may not be affected too much when you look at the drop of just about 1.6%, but you got to think of names like HP, names like Dell, that could obviously really be impacted from this drop that we are seeing in demand for PCs. All right, another big story of the day, and that is oil giant Exxon has engaged in preliminary discussions with fracking company Pioneer Natural Resources about a possible acquisition. This is according to a report from the Journal. Now, taking a look at how shares reacted to this news today, Pioneer Resources closing up nearly 6%, Exxon off just about 0.5% today. For more on this, we're going to bring in Jason Gableman, TD Cowen, Director of Sustainability and Energy Transition. Great to have you here. So just your first thought about this report, this possible acquisition here from Exxon of Pioneer Natural Resources.
Yeah, the reporting seemed a bit light on the details, and this is an M&A story that seems to get rehashed every year. It didn't sound like anything is imminent. The reporting suggested a deal could happen later in the year, but it's unclear at this point. So I'd say really no surprise from a reporting standpoint, something Exxon likely looks at a pretty regular basis among other M&A targets.
Just wondering, in your notes, you're saying historically we've observed that E&Ps, that's exploration and producers, tend to be taken out around a 20% discount to net asset value, which in our measure would equate to $280 per share of Pioneer, roughly a 40% premium to share prices. Pretty steep there. What goes into that calculation, if you could just share that with us?
Yeah, it's just the MPV of the resource. So it's the present value of the resource base of Pioneer. And that's actually a comment from my colleague who also wrote the note, David Deckelbaum, who covers Pioneer here. But when you factor in that potential premium, the deal looks much less accretive to Exxon's near-term multiples than if you price it off of the current value that Pioneer is trading at. And so as M&A gets factored into the stock, the value enhancement to Exxon appears a lot smaller versus where Pioneer is currently trading.
So Jason, if this deal ends up not coming to fruition, if we don't see Exxon there targeting Pioneer, are there any other potential targets there from Exxon, just given the fact of their interest in Permian Basin?
Yeah, so there's a multitude of Permian operators, as you and others well know. And what Exxon is looking for is something that's of scale in the Permian Basin, that is a large undeveloped resource footprint. There's probably some other players out there that fit those criteria, but it also has to be at the right price, and that's really the trick. The other thing Exxon's noted is that it doesn't want to buy something at the top of the commodity cycle, and at the time of its last earnings calls, it implied that that's kind of where we are right now, where companies that if they're looking to sell are maybe pricing in a higher oil price than what Exxon would price in if it were buying something. So that bid-ask spread also needs to narrow if Exxon, in order for Exxon to consummate some M&A.
Well, we're talking about forecasting oil prices here. Got to talk about OPEC Plus with its big surprise decision just a week or two ago to cut production by 1 million barrels per day. That sparked a short covering rally. So we now see WTI hovering around $80 per barrel, but that could go up, that could go down based on several factors that we've seen here. How do oil companies prepare for this? And isn't that in fact why they've been so hesitant to make some big deals over the last few years?
Yeah, what we've seen from oil companies and U.S. E&Ps in particular is investing less in the ground and giving more back to shareholders because those E&P companies did not generate great returns when oil prices were quite volatile in the prior cycle. And the super majors like Exxon have taken a lot of costs out of the business or being more stringent on what they're investing in from a capital allocation standpoint. And it enables them to have more flexibility to return more cash to shareholders and be more nimble in executing M&A when those opportunities present themselves.
Hey, Jason, we're just getting started here with earnings season. What are your expectations for energy? Because, yes, when you take a look inside the XLE, when you take a look at some of these individual names, they have performed okay, given the fact that we're up against a very tough macroeconomic environment.
Yeah, commodity prices are hanging in, and it's not only oil prices that are relatively high, supported by OPEC Plus, as you noted, but also refining margins near or, historically much higher than they've been. Global natural gas prices at much higher levels than they've historically been at. And when you combine the high commodity prices with costs being taken out of the system for these oil companies and, fund flows probably having some upside, just given energy is only 5% of the S&P, half of where it's been in the prior cycle, it does seem like there's a combination of more durable earnings and maybe some fund flow support that could support energy over the next year, and in particular, the global super majors.
We got time for one more. I'll give you the floor. Anything we didn't get to that you might want to talk about inside the oil energy or the oil industry here?
I can mention ESG just for a minute. I think one thing we've seen as a result of the war in Russia is when you take away hydrocarbons from the global energy mix, you end up using a higher emissions energy source. And I think investors are starting to see that and understand it's going to take more time to transition away from oil and gas to new energies. And that could be supportive of equity values for the IOCs vis-a-vis the higher terminal value that you would apply to the stocks. So I think some of the ESG headwinds that we've seen within the energy space are abating somewhat, and that should be supportive of the space as well.
All right, glad we got that in. Always good to talk to you. Jason Gableman, thank you. Coming up, technology stocks rallied in the first quarter as investors look to avoid turmoil in the banking sector. We're going to tell you what you need to know and what you're going to need to watch out for Q2 coming up.
PC sales slumping worldwide in the first quarter of the year, with Apple seeing the largest drop of more than 40%. That's according to the latest data out from market research firm IDC. Now, yet tech stocks are rallying overall as investors are seeking shelter from the recent banking turmoil. But what does all this mean here for forecasts for this earnings season? We want to bring in Constellation Research principal analyst and founder Ray Wang. Ray, it's great to see you here. So lots to unpack. You got what we want to talk to you about today. Let's start with the drop that we're seeing in PC shipments. Apple there obviously taking the brunt of it, posting the largest drop year over year. How big of a blow is this to Apple?
Well, PCs make a small part of Apple's revenues, but not not an insignificant amount. And we've been expecting this for the last 6 months, mostly because we're coming out of a pandemic cycle where everybody refreshed. And so the next refresh cycle is going to be in 18 months. And I think we're going to have to wait that out, not just with Apple, but with other PC manufacturers as well, as you're seeing for Lenovo, HP, and Dell. And so you've seen Apple getting signs of this by cutting chip orders from TSMC over the past quarter. And we also have a glut in memory chips, but not in auto, GPU, or TPU for AI.
So let's talk about AI here. Big topic. We've seen Microsoft pivot to it recently. Google arguably pivoted to it in 2017. But it's come with fits and starts. And of course, there are problems. Just give an overview, if you could, what the major players are doing and how they're addressing some of the hiccups that they've had so far.
Yeah, so we're seeing a big push in AI from Microsoft. Satya is all in on AI. You see it across the Microsoft portfolio of products. It's coming in Bing for search. It's in Copilot. It's part of the open AI investment. And you're seeing the Azure data centers really strain under this, mostly because they're first generation and fairly inefficient. And most folks a few weeks ago experienced some glitches on Office 365, as you could see that. Google, on the other hand, has been taking a much more measured approach because they understand that if they release something too early, they're going to have some issues where people have lack of trust and accuracy of a search. So they've been taking a little bit slower approach. And then meanwhile, chip manufacturers like NVIDIA with their GPUs are going to be doing really well because they're positioned because AI requires a lot of compute power. And then across the board, you have other companies like Oracle in the AI app space, C3 in the AI app space, and companies like Adobe, which is taking AI to the next level.
Ray, is AI going to be the buzzword again this earnings season? Because it seemed like every time a tech company, really any company, mentioned AI, we saw that stock take off following its earnings results. Is that going to be the same case this time around?
We're going to see a lot of talk about AI. We're in the middle of that hype, but the challenge is we don't have enough data and we don't have enough compute power to do general AI the way we want to. And so a lot of companies are going to have to get really good at creating synthetic data, expanding their data sets, or actually having exponentially differentiating data sets. So we haven't hit that piece yet, but as people realize, I think I said this before, at some point ChatGPT thought I went to Harvard, but I wrote a book for Harvard Business Review. But my mom was pretty happy for a few weeks.
Yeah, my mom never had that problem. She's still wondering why I wouldn't. No, I'm just kidding. I got to ask you about the tech rally that we had in the first quarter of the year because we have tech earnings on deck in a few weeks. What is the market expecting here? Because arguably that rally that we saw in Q1 was more about the Fed. As I'm reading in your notes, you tend to agree with that. Then it was the basics, the fundamentals of the tech trade. But how do you think this the next few weeks evolves here?
I think it's going to be a crucial point in tech earnings. Market already expects some bad earnings. The Fed rate hikes were at near peak. So we're hoping that the Fed hikes are going to come down. But the challenge is not all the tech stocks are doing well. If you're not in analytics, automation, AI, cloud, or cybersecurity, you're at risk because you're no longer deemed as critical. We talk to about 1,000 CXOs on a regular basis, and they're all in the midst of cutting costs, renegotiating contracts, and we're about to see that wave come through on the tech earnings.
So, Ray, you joined us at the beginning of the quarter. You were all in on Matana. A number of those names have done well. That's Microsoft, Apple, Tesla, Alphabet, NVIDIA, and Amazon. Meta, though, was not included in Matana, and that stock has done very, very well since the start of the year. What do you make of that really meteoric rise and whether or not that trend to the upside can continue?
They did amazing, right? And if you look at the top 5, top 6 stocks, it's still within Metana, and then Meta is right at the edge of where the old FANG numbers were, FANG stocks were. Meta did well at about 76% growth for the quarter, and it's because having billions of users and active users is still very important. Even though ad tech is down and ad sales are down, they're still able to hold their numbers, and they did a lot better. And of course, the market had overcorrected for Meta before the beginning of the year.
I want to ask you about the tech layoffs and how that's progressing. We got I think it was late last year, we started getting the dribbles. Has this and we haven't seen it really translate into some of the big payroll numbers that we track on a month-to-month basis, but just wondering from your inside view in the industry, how is this progressing and is it set to get worse?
So right now, most organizations have gone through a 5 to 12% restructuring. And what that's been doing across the board is they've taken out projects that were probably experimental. And this is what happens when you have a low interest rate environment. You can make a lot of big bets. But as everybody realized, there's a lot of efficiency out there. What Elon was able to show by cutting the number of engineers, and he might not have gotten the right number down, but there's a lot of automation ahead and a lot of AI that can be applied. And I think every organization is right now trying to figure out what level of operational efficiency they can deliver. So we're going to see how automation and AI continues to change how we work as we fully automate. We're going to have to ask, when do we do full automation? When do we augment a machine with a human so we can train them? When do we augment humans with the machine so we can be a lot more efficient? And when do we actually insert the human touch and actually have personalized service?
Yeah, I'm waiting for Google Brain right here myself. So on pins and needles, Ray Wong, thank you very much. And always appreciate your insights here. Coming up, President Biden weighs in on his re-election bid. Biden saying he plans on running in the 2024 election, but he's not exactly prepared to announce it just yet. So what's he waiting for? We're going to discuss that on the other side of this break.
Are you saying that you would be taking part in our upcoming election in 2024?
Well, I'll either be rolling an egg or being the guy who's pushing them out.
Come on, help a brother out. Make some news for me.
I plan on running now, but we're not prepared to announce it yet.
That was President Biden at the White House Easter egg roll, reiterating what he's been saying for months, that he plans to run again in 2024, although ceding no further details about a potential campaign. And to discuss what this means for the Democrats next year and beyond, let's bring in Yahoo Finance contributor Kevin Cirilli. Kevin, what are the odds?
Well, here's what's happening in his neck of the woods, President Biden's, is that, look, he's lagging in the polls, but the Democratic strategists that I talk with say that should he run, he would, without question, have all of the support of the party. He's going to have to make some type of an announcement on this. And to his supporters and the Democratic strategists that I talk with, they say that until he definitively answers the question, definitively gives some type of an announcement, then the question mark will still loom large. Separately, the Republican race is already underway. For as much of the news of Trump's indictment of the last week or two ago, it really had an effect on the Republican field, where every other potential and already named Republican candidate has had to defend Trump. And you've seen the Gallup polls, for example, and the Reuters Ipsos poll that came out in the other week that has Trump ascending by a double-digit lead, and Florida Governor Ron DeSantis trailing now Trump by double digits. And that's something that I think the Republican challengers are starting to wake up to, is that Trump is still very much the front runner on the Republican side.
So, Kevin, that's for 2024. Let's talk about an issue here that I'm sure President Biden, I know President Biden in the White House, obviously very closely monitoring. China's military declaring that it's, quote, ready to fight. This comes after 3 days of those larger scale combat exercises around Taiwan. My question to you, Kevin, is how do you see this? Do you see this affecting U.S.-China relations, and how so?
Well, quickly, I would say three things. First and foremost, the military drills that the Communist Party of China just concluded in the last 24 hours were a bit more tempered compared to the military drills that they deployed when now former Speaker of the House, Nancy Pelosi, traveled to Taiwan. And the analysts that I'm reading would suggest that the reason that happened is because President Tsai of Taiwan met with current Speaker McCarthy in California versus, of course, Pelosi's trip to the island. Secondly, so I think from an analytical standpoint, it's a bit more measured in their response. Secondly, look, I also think that China's waking up and knowing that they can't play peacemaker like they tried to do with French President Emmanuel Macron the other week and put some, I guess, 12-step program in place for Russia's war with Ukraine, but then also attack a democracy island of Taiwan, an incredibly important ally to the United States, to NATO, to Western nations, and to nations that support the rule of law. So China's trying to have their cake and eat it too. They're trying to play peacemaker, and yet they're continuing with this war sabering in the Taiwan Strait. And I think that most, measured people would realize that that's hypocritical, to say the least. And then lastly, I think what you're also noticing is bipartisan support from the United States for Taiwan. I mentioned Speaker McCarthy's successful meeting with President Tsai, similar to now former Speaker Pelosi's successful trip to Taiwan. But we should also note that there was a bipartisan delegation that was in Taiwan, led by House Foreign Affairs Committee Chairman Mike McCall of Texas. And there were also another bipartisan group of lawmakers who met with the business community out in Silicon Valley last week, talking about what the business community and the public and private partnership can do in order to support democratic values, democratic principles, and to support Taiwan. So I think China is really, if they continue to move the goalposts as what has been the strategic norm for decades, they're going to continue to do something that it seems to be a rare moment here in Washington, which is to unite Republicans and Democrats around the support for Taiwan.
Yeah, very rare to get bipartisan support these days, but this, of course, one issue that is proving that. All right, Kevin Cirilli, great stuff. Thanks so much. Coming up, footing the bill for adult children. A new study showing over 2/3 of parents with children 18 years and older have made or currently are making financial sacrifices to help their kids. We are going to discuss Bankrate's latest findings on the other side of the break.
Leadership in times of economic uncertainty, one of the critical elements is around communication, transparency, and I think it's frequent communication, and probably most important is authenticity, being authentic and having people trust that what you're telling them is accurate and enables you to lead the company or the teams through this period of uncertainty. I have not changed leadership style during this time of uncertainty, And if you add the pandemic, which was a very uncertain time for so many people, one of the things that we have seen is during this time of uncertainty, and particularly through the pandemic, people were looking for more leadership from the company and from the leaders of the company, and including taking positions and communication on things that may not be directly business related. So I've felt even more accountability and responsibility in my role as a leader as we've been going through such an uncertain period of time for so many employees. Clearly, trust and confidence are really important to lead people and lead teams. And so I'm looking for those in people who can build and create trusting relationships. Collaboration is also very critical. I'd characterize it as a coaching mentality as opposed to a management mentality. Coaching means I'm investing in people to help them perform well and to be successful, to achieve their objectives, as opposed to I'm managing a group of people. So all those I think are really important. First, I'd say do what you're passionate about. Make sure that you believe in the purpose with what you're doing, because if you do that, you can do something with much more energy, enthusiasm, authenticity, and you could be that leader that people will look up to. And then the last thing I'd say in terms of recommendation is lead by example. Don't ask other people to do what you're not willing to do, and people are paying attention to what you're doing more than what you're saying.
Amid fears of a recession and record high inflation, young adults are relying more on their parents for financial help. According to a new Bankrate survey, 68% of parents have made a financial sacrifice for their adult children. Now, Ted Rossman, Bankrate's senior industry analyst, is here with more on the survey. So, Ted, majority clearly of parents are helping out their adult children, which is defined in your survey as 18 and older. What was your takeaway from this, and how does this compare to your results in prior years?
Well, one big takeaway, I think, is it's hard to get about 7 in 10 people to agree on anything. So I do think that it's significant here that so many parents of adult children are supporting those kids. We don't have a lot of historical info. We did a study back in 2019 that was all about retirement savings, and we actually found a little bit more people back then saying that they were cutting into their retirement savings to help their kids. But, this time we got a little deeper about emergency savings and debt payoff. And I really think across the board, this is more of an issue now than it was certainly 10 or 20 years ago. I mean, I do empathize with young adults. I think it's harder now to get started given student loans, given high rents, that sort of thing.
Well, I'm looking at the results of your survey here. Specifically, at what age do you think a person should start paying each of the following items or bills on their own? And when you look at the overall results, there's nothing under the age of 20. In other words, car payments, that starts at 20, car insurance at 20. Then at 23, you have health insurance and student loans. Even if you break it down by generation, not shown on the screen there, but baby boomers, their lowest number is 19. So they think that they should be paying for youngsters car insurance until the age of 19. This seems to me a generational shift to me, because I remember 20 years ago, those numbers seem a little bit high. But why is this phenomenon happening? Can you put some underpinning behind this? Is it simply that much more expensive? Is it that more difficult to enter the labor force and establish oneself? What's going on here?
I think even if you were to back out inflation, I do think life is more expensive now than it was when, say, boomers were that age. I mean, I think there's no doubt that student loan burdens have grown, rent costs are way up, barriers to entry for the home buying market are much higher now. So I do think there are some real challenges here. You might say also that there could be a bit of helicopter parenting going on. I mean, I do think there are some risks here. Even though we want to be empathetic and we want to help our kids, I do think there are some downsides. One, I worry that parents are hurting their own finances because, hey, life's expensive for them too. And if you're going to finance a 30-year retirement and pay for healthcare costs, I mean, there are some risks to cutting into your own nest egg. But then the other thing is enablement. You don't want to be a blank check. You don't want to be contributing to this failure to launch. So it's hard to know exactly where and how to cut the cord. But I do think it's something that multiple generations are wrestling with right now.
Well, Ted, what are some of the things that maybe our viewers out there should be considering if you want your child to be financially independent? Maybe they're not 18 yet. What are some of the steps or some of the things that people can be doing to set their children up for success?
I think financial literacy starts at home. It's often not taught in school. I think you also need to be really clear with your kids about expectations. It's great if you can afford to help. Remember that thing on the airline, though, about put your oxygen mask on before helping others. I mean, we don't want to do this to your own detriment, but if you can afford to help, do it. But maybe with some guidelines, and maybe you pay for certain things for a certain amount of time, but not forever and not everything. Or if your kids are living with you, maybe you charge them nominal rent, or they contribute to the household costs like groceries and utilities. And maybe you even bank some of that as kind of a freedom fund, and you can give it to them later on as part of the security deposit for an apartment or the down payment on a home. I think it's important to be empathetic, but also to have some guardrails and some tough love at times.
Yeah, we've seen so many things change over the last 3 to 4 years because of the pandemic, notwithstanding other exogenous factors as well. Just wondering, have the tough conditions that we experienced over the last few years, are those abating somewhat given the most recent survey or any other surveys that you've been conducting?
At least the job market's strong. I mean, that's one real silver lining here. On other fronts, it's more difficult, though. High inflation, higher interest rates, these are things that are definitely weighing on people. We see more people carrying credit card debt. We see those rates at record highs. These are things that I worry about on both sides of this, because we're saying it's hard for young adults to get started, and it is. But what about those 50 or 60 or 70-something parents? I mean, if they're carrying credit card debt in retirement, that's a tough one. And chances are their bills have all gone up, including healthcare. That's a really big one for older people. So I do think that you need to kind of strike that right balance and make sure to prioritize the relationship too, because we found in a different study that about half of people who've lent money to family or friends had something go wrong. They lost money, their credit score was damaged, the relationship was damaged. You want to be mindful of those potential consequences.
So, Ted, if people are trying to get their kids off of their bills, whether it's streaming, healthcare, you mentioned a few times, housing costs, a number of parents are helping their children out with housing, rent. If that's the case, what are some of the steps that they could do or should do in order to reduce maybe that burden in a year or two?
I think it's important to communicate early and often about this. You don't want to just cut the kids off cold turkey, but maybe have some sort of path to freedom, whether that's sort of gradually reducing the amount you're giving or being really clear about that timeline, that glide path to weaning off assistance. I also think having the kid have some skin in the game is important, whether that's paying nominal rent if they're living at home with you or contributing to other costs. It's common for kids to stay on the family cell phone plan for a long time, or maybe the parents put the bill for car insurance or healthcare, but maybe the kids can kick in for at least some of those costs. And maybe gradually the amount they're kicking in can rise. And at some point, hopefully in the not too distant future, you've totally cut the cord, because part of your duty as a parent is to support your kids on this journey to being self-sufficient. So you don't want to enable their financial habits forever and ever.
Well, I know a few parental units, some friends of mine who are looking forward to cutting that cord finally with their own 20-something-year-olds. So hope springs eternal. Ted Rossman, thank you very much. Coming up, we're going to break down a new report on the cost of mining Bitcoin, the environmental cost. That's up next.
100-plus cars on display here. One clear theme: the EV surge is here. It's a great time to be shopping for an electric vehicle. Automakers are expected to spend over $1 trillion in the next decade to develop and deliver the next big thing in EVs. Tesla spends the most on R&D per car sold. It also sells the most EVs, taking 4 of the top 5 spots in 2022. But other companies are catching up.
We actually talk to new vehicle shoppers every single month, and we ask them, are you interested in purchasing an electric vehicle? 27% say yes, very, very likely. And the number one brand has consistently been Tesla, but the last few months we've seen Chevy overtake them in brand consideration, and Ford is right there behind them.
More choice, competitive prices, and generous government subsidies are all powering the EV market right now. But one big issue standing in the way of electric vehicle adoption: charging ports.
Now, if you've got a charging station at home, you've got a level 2 station, great, that helps a lot. We're still a little ways away from the great American road trip in an electric vehicle. It's an ongoing process. Things will get better. Folks get these things at home, and then we get more and more infrastructure. The bipartisan infrastructure bill will go a long way to doing that.
California leads the way with 44,000 charging ports, more than 4 times the number 2 on the list, New York. Naturally, some of the country's least populous states, like the Dakotas, have the least amount of EV chargers. And now, even oil and gas companies are building charging stations. BP just announced a $1 billion investment in the U.S. over the next several years. Charging stations are one piece of the puzzle. Another key element for mass adoption of EVs is buy-in from car dealerships. I caught up with Mark Scheinberg, the president of the largest regional automobile dealer networks in the country and one of the organizers of the New York Auto Show. How hesitant are your dealers to making this full transition away from gas-powered?
Well, any business person, when you say, listen, you've got to invest $1 million into this, they're going to go, yeah, show me the return on investment. But dealers are like a lot of entrepreneurs. They see a business climate. They understand that this is what is coming down the pipe. They need to come, to work with it. It is a big investment on their part on it, but they do believe that, this is where the business is going to be in the future.
The true cost of mining digital currencies. The New York Times reporting just how much power is being used, how you could be paying for it, and what it's doing to the environment. Joining us now is the author of the story, New York Times Deputy Investigations Editor Gabriel Dance. Gabriel, thank you for joining us here today. Just gives us a little bit of the overview, some of the research that you did coming into this story and what you found.
Jared, thanks so much for having me. So yes, I became interested a few months ago in just why this industry was consuming as much electricity as it does. And what I found was that many of the companies were extremely reticent to speak to exactly how much energy they consume, where they're located, and much more about their operations. What I discovered was 34 operations spread across 15 states, each one using at least 30,000 times as much power as the U.S. American home. It's an incredibly vast amount of energy that they're using, and of course that results in large amount of emissions. The amount of emissions was about 16.3 million metric tons of carbon dioxide, which is about the same as adding 3.5 million gas-powered vehicles to the road. So it's not only an enormous amount of energy they're consuming, but the resulting emissions are quite extensive as well.
And one of the counter arguments to this, to people who support the energy that feeds into the energy, is that a lot of these Bitcoin mining sites are placed around sources of renewable power, and they're just consuming power that wouldn't have been produced by, I guess, carbon-producing power plants in the first place. But there are the devil's in the details, I guess you could say.
I think that's very accurate. So yes, as you said, the miners like to say that they set up in areas where there's a lot of excess renewable energy. But working with a nonprofit that studies this type of information, Watt Time, what we discovered is actually in almost every location they set up, the vast amount of renewable energy is already being consumed. So their operations actually result in fossil fuels, natural gas, coal plants turning on 85% of the time. So while they say that they operate in areas of renewable energy, the truth is most of that energy is already being used. So their operations cause more power to have to turn on to meet that.
What I found particularly eye-opening are some of the rebates and financial incentives that some of these companies, some of these mining companies are given specifically by the state of Texas and maybe some other places that you found in order to shut their operations if electricity prices or electricity use is too high. I guess maybe they get a phone call or an email and then they shut down, the miner will shut down some of their operations. They'll receive a stipend from the government or a payment for that, and some of those payments are amounting to tens of millions of dollars.
It's a fascinating industry they've forged for themselves, and when you are in the business of turning electricity into money, there's a variety of different business models that become available when you do that. So one of those is, of course, mining Bitcoin. But as you said, there are a few other options, one of which is when you use that much power, grid operators will actually pay you to promise that you will stop using that power if the grid becomes really strained. You're acting as a type of insurance. And some of the miners participate in this program 85% of the year, but they're only called upon to shut down a fraction of the time. We're talking 3.5 hours total in 2022, yet they're receiving payments for 85% of the year, to your point, between all of them for tens of millions of dollars. And they have another option, which is when the power prices spike, they'll shut down and start selling their energy back into the market. So when other people, particularly in Texas, are paying the most for their electric bills, the miners are selling their power back in. Their extreme flexibility also allows them to shut down and avoid fees that are assessed to everybody else in ways that other people can't possibly avoid. Now, it is important to note that these operations, these grid stability operations, are helpful to grid operators. And the Bitcoin miners love to stress that point. What they don't like talking about so much is the fact that they're paid handsomely to do this.
Well, let's talk about solutions, and assuming that Bitcoin is going to take the same amount of energy to produce, what are some of the steps that are currently being taken to mitigate the impact of that? I remember something, maybe it was a year or two ago, being sourced, and it was likened to the blood diamonds movement that we've seen for some of the sustainably sourced materials that come out of mines that are in conflict areas. Maybe something similar for the Bitcoin industry, which is is that it's using electricity that has been sustainably or reliably sourced from wind power or solar power, for instance. Has that gone anywhere?
Well, right now, the Bitcoin industry as a whole doesn't have enough financial credibility to do things like what Google and Facebook and Meta and some of the previous data centers who underwent some of this very similar environmental criticism about 10 years ago have done, which is, to your point, to build additional renewable energy that they either use that energy or they pay for the construction and create financial power purchase agreements with that additional new renewable energy to meet hour for hour the demand that they are putting onto the grid. But as I said, right now, miners don't have that kind of financial credibility, as we've seen with the price of Bitcoin falling tremendously over the last year. Some of the miners don't even have enough energy or money, to operate when the cost of electricity rises with the Bitcoin coming down. So it is a complicated issue, but there are ways that they could act much more sustainably, including in West Texas, where there is at times some renewable energy that is curtailed. The miners could very easily sit and use that curtailed energy when it's otherwise not going to be used.
And who knows, maybe proof of work, which is really the energy intensive form of cryptocurrency mining, maybe that will just transform into proof of stake someday, as it has with Ethereum, but not for Bitcoin right now. Really appreciate you being here, Gabriel Dance. Coming up, we're going to break down some of the biggest takeaways from today's stories. Stick around.
As we head into bank earnings, there's a phrase you're probably going to hear a lot of. It is net interest margin. So we want to tell you exactly what that means. It's the difference between the interest that a bank pays out and what it brings in. So in other words, a bank takes in deposits from you, from companies, and it pays interest on those deposits. So that's the money that it pays out. Then it also loans out money to you, for your home, for example, to businesses, and then it collects interest as a result of lending out that money. The difference between those two numbers, that is commonly referred to as net interest margin. So in other words, if I'm depositing my money in the bank and collecting 3% interest on that, and then also if I am borrowing money from the bank for whatever it may be, and I'm paying 7%, say, on that loan, the difference between those two, 4%, that's the net interest margin. But to get a little wonky for a second here, the technical definition then takes that number and divides it by the average earning assets at the bank. All that means is all the other stuff on the balance sheet that doesn't really move around that much, stocks, bonds, etc., that's where you get the net interest margin. It's also especially relevant right now with a period of rising interest rates. Why? When interest rates start to go higher, more people want to put their money in savings at the bank because they're getting actually some interest on that for the first time in a long time. And maybe fewer people want to borrow money because it's more expensive to do so. So it's particularly relevant right now, and we're going to hear a lot about it once the banks start reporting.
It's closing time here at Yahoo Finance. Let's get you caught up on some of the biggest headlines of the day. Tesla cutting prices again. The EV maker slashing prices in the U.S. for the third time this year. The company also announced that it will build a Megapack battery factory in Shanghai. Now, Tesla hopes the new facility will be able to produce 10,000 of its giant batteries a year.
And Apple Mac shipments fell sharply in the first quarter. According to research from IDC, Apple's worldwide computer shipments fell 40.5% year over year in Q1. However, it's not alone. All of the top 5 computer makers saw their shipments fall amid an overall PC market slump.
And finally, AMC closing higher by 7%. The theater chain says that it had its busiest weekend of 2023 and its third busiest since the pandemic. The chain crediting the strong opening for Super Mario Brothers, which raked in more than $146 million at the box office over the holiday weekend. And before we go, be sure to check out our own Jennifer Schomburger's exclusive interview with New York Fed President John Williams. That's at 9 a.m. Eastern Time tomorrow. You won't want to miss that. Well, that'll do it for us today on Yahoo Finance. We will see you tomorrow at 9 a.m. for that interview and back here at 3 p.m. Eastern Time for all your coverage leading up to and after the closing bell. Have a great night.